So we're here today to talk about our business game. Okay, we need to talk about various things. We need to talk about where we are now, what we did to get there, and how we all work together as a group. So let's start off with where we are now. At the end of the game, we were ranking 15th out of all the other groups, which is quite a strong position to be in. We had 12.39% of the market share, and we had a large amount of cash in hand, which would have meant that if the game had continued, we would have had money on hand to invest into R&D, marketing, etc. The company was valued at $1,335,704. So overall, I think we were quite strong, and we also retained quite a lot of shares. We didn't give away many except to employees. So overall, I think we were in a good position at the end of the game.
As you can see, our net profit margin shows a steady increase up until the 8th quarter, where it fell by 9%. Although our revenue had risen by nearly 30,000 compared to the previous quarter, this fall in the net profit margin was due to significant increased expenditure in both marketing and R&D, as we attempted to drastically increase our market share with the end of the 2-year period nearing. We undertook a 3-step DuPont analysis, which allowed us to determine what was the cause of the decrease in the percentage from the 5th to the 8th quarter. The cause wasn't the equity multiplier, as it remained fairly constant. However, the profit margin and the total asset turnover reduced substantially. This shows that our operating efficiency and our asset use efficiency were the catalyst for the sharp decline in the DuPont percentage.
Okay.
Overall, we found 9 points of significance in the market share. Increases in market share were due to investments and share delegation. The sensitivity of the simulation can be seen when we accidentally, on day 415, changed our marketing expenditure to $500 rather than increasing it by $500. Our market share follows Cooper's theory, how market share is a direct reflection of product performance. Our position as market followers rather than leaders, and our lack of large investments hindered our brand awareness and therefore market share.
So if we look at the investments we made in marketing and R&D, we can see straight away that we were very cautious with our investments. We only started out investing maybe $500, then rising it up to $1,000. So overall, we were very cautious, especially if you compare us to other groups. We actually only invested $8,000 in total at the end for marketing and $7,500 for R&D, so they were quite low amounts. You can see on the marketing chart that it does go up in increments. There is quite a big dip at one point, and that's where we decrease the marketing accidentally rather than raising it. So as Lizzie was saying, it is quite sensitive. With the R&D, we can see we only actually changed it 6 times, and there was a very large period where it wasn't reviewed at all. So perhaps we should have reviewed the R&D more regularly, and especially towards the beginning of the game rather than towards the end.
Following on from that, I think we can all sort of agree that we were very risk averse towards the game. We didn't undertake anything that would put us in a position where we could make a loss or where we would go into negative figures. So, in regards to that, yes, we were massively risk averse. Economically, I found when I was researching this, a lot of literature doesn't seem to agree with that, because they seem to state that if you have a lot of money, you're risk averse, which obviously wasn't our case, with us only starting with 25,000, I think, wasn't it? Yeah. However, I did find an interesting case written by a man called Rabin, who stated that actually there are a lot of other reasons why people are risk averse, which I think apply to us a lot more, because he sort of listed an unfamiliarity with the terrain, which did apply to us. We didn't have a specific product or trend to follow, so I think we were a bit more sort of averse to taking a risk in regards to what we were doing.
Overall, from the beginning of the game, we did use John Lewis as a guidance. Because they are very successful, we used their profit sharing model just for guidance to see what would happen. Bradley and Estrin said that employees may start to work harder, which would improve motivation and productivity. Overall, we gave 8,000 shares to employees, so we were quite reluctant to actually give shares because we wanted to keep as much control as possible. We were sustained from selling shares to outside investors. This is because we had enough cash anyway to make our desired investments, so this probably goes back to the risk aversion of why we had enough cash in hand.
Excellent. I think overall we performed quite well as a group. We communicated a lot, especially via the Facebook group, which worked really well to discuss things beforehand. I think it worked well that we all discussed what we wanted to do and then had one person, generally it was Pip, going onto the system and changing it, which was good, rather than lots of people going on there and getting conflicting changes. We did have a bit of a disagreement at one point about whether or not to invest more into R&D and marketing. Perhaps if we'd have had one person that was in charge of marketing, one person in charge of R&D, they could have made those decisions. But I think overall we worked really well as a group and we made good decisions. Looking at the game itself, there are definitely some criticisms that you can make of the game. To start off with, I think the fact that it runs so quickly isn't very realistic to life in some ways, especially as overnight lots can be happening, and it's quite difficult with such limited information to predict what's going to happen. So even putting in timed changes is quite difficult. And also the system of reducing and increasing expenditure meant that we did at times make mistakes, which obviously in the real world wouldn't actually happen.
I think one of the key things really that we learned was the unstableness really of business environments, and because the market could change so dramatically overnight, it was a good representative of how markets can fail, perhaps just like what happened in the recession, which made things a bit unpredictable. Another thing that we learned was potentially with higher risk we could have had higher return, which we saw with our competitors who were making higher risk investments, but also gaining back the high return. And also the third point would be to be more proactive than reactive, so we can combat issues before they potentially happen.
I think that basically, I think that was our biggest issue, was that we were in this position where we felt we had to react, because not necessarily because the game was limited, but because we didn't have a specific product, we did have to react. But I think we dealt with that quite okay.
I think overall we took a lot from the game, and I think we all learned quite a lot.
And I think within terms of the real world, how you have to make a decision quickly, not knowing what the result's going to be, I think we definitely did do that. Definitely more towards the end.
But definitely 15th is a good position. We did well.
Yep.